So I've just been going through YouTube and I've noticed that there's a massive increase in the number of content creators creating videos about crypto arbitrage.
I'm going into arbitrage, honey.
Sharing different platforms which they claim using the arbitrage method you can be making anywhere between $50, $200, and some even claim that you can be making up to $1,000. Now, as the saying goes, if it sounds too good to be true, it probably is.
It's too good.
Now, for those of you who are not aware what crypto arbitrage is, it's simply buying cryptocurrencies at a low price from one platform and selling at a high price on another platform, hence pocketing the difference as profit.
Buy low, sell high.
Now, while this might sound like an easy way to make money, there are a lot of things that you need to take into consideration. I have divided this discussion into 3 different parts, and in the first part we're going to discuss how crypto arbitrage works, and in the second part we'll look at the exchanges that people are recommending to use the crypto arbitrage and how the pricing system works on these various exchanges. Then finally we are going to discuss the reasons why I believe crypto arbitrage is not the ideal business model. Crypto arbitrage works by taking advantage of price discrepancies between different cryptocurrency exchanges. For example, a user buys one Bitcoin on Binance for $2,800 and goes and sells it at the Kraken exchange, maybe let's say for $3,000. So the difference, which is $200, will be the profit in this case. While the concept of crypto arbitrage may seem so simple, there are several factors to consider before engaging with this business model. But before we dive deep into the factors to consider, let us look at the types of crypto arbitrage. The 2 main types and most common types of arbitrage are partial arbitrage and triangular arbitrage. Partial arbitrage is the most popular and widely used method. This is where one buys cryptocurrency low on exchange A and sells high on exchange B, taking advantage of the difference, and that is the profit. Triangular arbitrage, as the name suggests, is a way of exploiting price discrepancies between 3 different assets. So let's say, for example, you have 1000 Tether USDT and you use that Tether to buy Bitcoin, which is BTC. You're going to exchange that Bitcoin to Ethereum, and the Ethereum you're going to sell it back for Tether. And you might discover that while you sell that Ethereum after buying it with Bitcoin, you discover that instead of getting your initial 1000 USDT, you might get maybe let's say 1005. You have a $5 as profit. The most commonly used is partial arbitrage, where you use 2 different platforms and you trade the same crypto on 2 different platforms. Now let us look at the exchanges that these gurus are recommending on YouTube. There are 2 main types of exchanges.
Hey, what are you saying? What types?
You know, those types.
There is the centralized type of exchange and also the decentralized exchange. Now, the centralized exchange is an exchange such as Binance that is regulated by the central authority, while a decentralized exchange is mostly less regulated or not regulated at all.
Rules don't apply to them?
These are websites you won't even have an address for it, you won't even know where the headquarters are, and you also won't know who is in charge of those decentralized exchanges. And mostly these are the most common exchanges used for crypto arbitrage, because that's where mostly the prices for crypto is high.
That price is sky high.
On centralized exchanges, the price of cryptocurrencies are determined by the free market. Supply and demand will determine the price for Bitcoin. For example, let's say if someone says I'm going to sell my Bitcoin at $3,000, then there's a buyer who happens to also want to buy Bitcoin at that price. So if they buy the Bitcoin at that price, the Bitcoin price now will be at that price, which is $3,000. It will go up. Now, in a decentralized exchange, it's a bit different because the free market does not determine the price of Bitcoin. In a decentralized network, they use the automated market maker system. These are types of exchanges where instead of prices being determined by supply and demand, the prices are determined by an algorithm that uses a pool of tokens. This pool is created by users who deposit their tokens into it and receive the corresponding values of the crypto. For example, imagine a liquid pool. Someone deposits, let's say, $10 million of USDT into the decentralized exchange. Let's say the owner deposits that amount. amount, and they also deposit another 10 million worth of, maybe let's say, Ethereum into the same exchange. Now let's say a client comes in, you come in and you instead choose to buy 500,000 worth of Ethereum from the platform. What will happen is that once you buy that Ethereum, it means the exchange will have less Ethereum left in their pool, and they'll have more USDT Tether since you bought using Tether on the platform. So what happens is that the price of Ethereum on that exchange will go up while the price for Tether will go down, because the supply for Tether on the platform is high while the supply for Ethereum is low. So meaning because it has become scarce, it is more valuable as compared to where it is determined by the free market.
Hey, y'all, come look at this.
They use Bitcoins.
While crypto arbitrage may seem like an easy way to make money quickly, there are several reasons why I believe it is not a sustainable business model. It is also important to note that cryptocurrency prices can be highly volatile. There are sudden price swings happening frequently, and the risk of losing money due to sudden price drops is very high. Now I know that a lot of these gurus make it seem so simple and so easy, such that when you think of passing on the opportunity like a very huge mistake, but I'm here to tell you something that these gurus are not telling you. Most of these platforms that they are recommending for crypto arbitrage, these platforms have paid these gurus to promote them.
They pay, I do job.
I have personally turned down a lot of different platforms, especially on crypto, that are trying to get me to promote their platforms in exchange for a payment. The reason being is that I don't want to be part and parcel of helping you lose money to scams. Now, don't get me wrong, I'm not saying all of them are scams.
Actually, it sounds like you are.
But most of these platforms, especially on crypto, they are huge scams. Cryptocurrency prices, as I earlier mentioned, are highly volatile. Within a split second, the price can be $1,000. The next moment, the price can be $500, and you might lose a lot of funds while engaging in the arbitrage method. So it is highly difficult for you to actually do crypto arbitrage, especially that we are unable to control time on the platforms that we don't own. Now, in this case, you might discover that, let's say for example, you've bought cryptocurrencies on Binance and you have to withdraw it to sell on another platform. The time inefficiency of blockchain can also add a risk factor to your strategy. For example, blockchain transaction speeds are sometimes so slow, and the change by the time the transaction is approved can impact the profit you might make, and most of the times you might end up making a loss. You can also have legal barriers such as anti-money laundering checks or geo-blocking, because most of these platforms, they will have to do a background check to see that the funds you're trying to exchange or trade are actually legit. Most banks do not even support buying cryptocurrency using your own card, and having to move from one platform to another just in order for you to deposit into these platforms can hinder you taking advantage of the price discrepancies or differences. Secondly, while arbitrage trading can look easy, profitable on the surface, it's important to note that withdrawing, depositing, and trading crypto assets on these different platforms cost fees, especially if you are using a bank that is using a currency different from what the platform is using. For example, on Binance, you can't buy cryptocurrency using a card that is in US dollar. So you have to use a card that is in different currency, or deposit via wire transfer, which is very difficult, or use a third-party platform to deposit into Binance. Now, while you are doing that, your bank will charge you some fees. Then also the exchange will charge you some fees to depositing. Buying the initial cryptocurrency you want to use will also incur some fees. Exchanging that crypto to the cryptocurrency that you want to trade for crypto arbitrage, you also incur some fees. Then withdrawing from that platform to the platform where you want to do the arbitrage, you also incur some fees.
Additional occupancy fee, resort fee, share fee?
Now this results in you, if you have a very small amount, you will most likely going to make a loss. You have to have a large amount so that the fees that are being consumed while you are doing those exchanges charges, they'll be covered up when you make a profit. So let's say, for example, if you incur $30 in fees, you need to make a profit above $30 so that you can subtract that loss also from the profit now, which is almost impossible, because the highest I believe you can make from crypto arbitrage maybe 1 to 5% of your total amount. So let's say if you had $1,000, most likely make $10 as a difference on $1,000. Now this is also a high risk on your part. If it happens that these platforms are scammy platforms and you deposited money in them and out of nowhere you discover that those platforms do not allow you to withdraw your funds, you might end up losing a lot of money just trying to make a $10 because of that. Now the third reason is that there is high competition in the cryptocurrency world. Now because you are trying to do arbitrage, like I've mentioned, there's a lot of people who are sharing these videos, and it's not only you that is watching those videos, and not only you is seeing those platforms they are sharing, and also the coins they are recommending you to do arbitrage with. So what happens is that a lot of people will see that video or will get that information, and a lot of people will try to trade that same cryptocurrency. Now what will happen is that if you are using a centralized network, like I mentioned, that the pricing is determined by the free market. So if they notice that a lot of people are buying a certain currency or a certain crypto, the pricing will go up because there's high demand for that currency, which in turn will result in others making a loss, because by the time you purchase, maybe on the other platform the pricing might have gone down because others have already taken advantage of this same method. So the competition is very, very high. Another reason why crypto arbitrage is not ideal is technical issues. Now when you just do a simple check, let's say for example some of the sites that have been recommended by the YouTube content creators, just try to check the reviews of these platforms and you find a lot of complaints about these platforms, whereby these platforms, once someone makes a deposit, they are requesting them to make another deposit as verification, which is very unheard of. And I can assure you mostly they're just doing that to frustrate the client, and because these are decentralized platforms, it's very difficult for you to get your money, and mostly you end up losing your money because there's nowhere where you can report these decentralized networks, or nowhere where you can take your complaint, apart from helping others to be aware that these platforms are scamming individuals out of their money. So technical issues happen whereby maybe you deposit, then they might even take 24 hours to verify your crypto that it actually came from you, which is a very big disadvantage when it comes to arbitrage method. So if you are willing to take that risk, you might end up losing a lot of dollars, a lot of cryptocurrencies based on this business model.
It's all lost.
Now the other and most important reason which I believe you shouldn't involve yourself with crypto arbitrage is the pump and dump scheme that happens in the crypto world. In fact, it happens in every trading world. So now what happens is that a lot of influencers or some group of people will take to social media and try to spread false information like this cryptocurrency is going to go high, this currency is going to increase by this date, and the likes and the likes. So what will happen is that a lot of people, let's say for example, say Shiba Inu is going to reach maybe say $10 by the end of this month, and now the price of Shiba Inu will go up, and a lot of people, while it's maybe at $5, they'll start buying Shiba Inu, and what will happen is that those same gurus who are influencing them, they are selling the same crypto, they are selling it to you, and while you are buying, what will happen is that once they've sold or they've made a lot of profit, the price for that crypto crashes.
Dunder Mifflin's share prices fell 73%.
How you bought it at $5, now the price has sliced right maybe to 0.1 cent, and now you have made huge losses. This is very, very common in the crypto world, especially even in the trading world, the pump and dump method, and a lot of people have lost money because of certain influencers who create false news or false information about certain crypto or certain currencies. So if you are someone who goes into this business model of crypto arbitrage, know that you might end up being misled.